Hey guys, what's up? I'm Erin and welcome back to the channel. If you're 65 or older, Washington may be prepared to change your tax bill in a big way. As part of the newly proposed One Big Beautiful Bill, Republicans are proposing a major expansion to the standard deduction for America's seniors. But here's the twist. The House and the Senate versions aren't the same. The House wants a $4,000 bonus deduction for seniors. The Senate, they're going bigger, proposing $6,000 per filer. It may sound like a small tweak, but for millions of retirees, that could mean hundreds in tax savings every single year. And whether or not you benefit comes down to one major thing: your income. Let's break down the bonus deduction. If you're 65 or older, you already get an extra tax deduction. $2,000 if you file single, or $3,200 if you file jointly and both spouses are 65 or over. This stacks on top of the standard deduction, which in 2025 is $15,000 for single filers and $30,000 for couples. The proposed bonus deduction adds an additional $4,000 or $6,000 per person deduction on top of the standard deduction, depending on which version passes, whether it's the House version or the Senate version. Let's look at a real-world example. Let's say we have a single retiree who's age 67, earning $50,000 a year. To keep things simple, we're only going to look at the standard deduction and the bonus deduction or proposed bonus deductions here. Under the current law, the standard deduction is $15,000. And for those 65 and older, they qualify for a $2,000 bonus deduction. So the total deduction here would be $17,000, bringing the taxable income to $33,000. Now let's look at it under the House plan. This proposes a $4,000 bonus deduction for seniors. So here the new deduction would be $21,000. The taxable income would be $29,000. And under this plan, the estimated tax savings for someone in this income range would be $400 to $500 for the year. Under the Senate plan, we get a larger proposed deduction, this time $6,000 for seniors. The new deduction would come to $23,000. The total taxable income would then be $27,000. So here, the total estimated tax savings would be about $600 to $700 for someone in this income range. Now let's say that you're a retired couple with an $80,000 combined income for the household. Under current law, the standard deduction is $30,000, and for those 65 and older who are married filing jointly, they qualify for a bonus deduction of $3,200. Total deduction here is $33,200, bringing the total taxable income to $46,800. Now, let's look at things under the proposed House plan. This adds a $4,000 deduction per person, so in this case, $8,000. The new deduction would be $41,200. Total taxable income in this case, $38,800. So the total estimated tax savings for a couple in this income range would be about $850 to $1,000. Now under the Senate plan, we have a proposed additional deduction of $6,000 per person, bringing that bonus deduction to $12,000. The new deduction in this situation would be $45,200, bringing our total taxable income to $34,800. Total estimated tax savings for this couple is $1,300 to $1,500. The more taxable income you have, the more value you would get from this expanded deduction. For those seniors who are lower income earners who are already paying minimal amounts in federal income taxes, they would experience minimal value from this. That's why this deduction is really aimed at helping those middle income earning retirees. Now that we know what the bonus deduction is and how much it could save you, let's talk about who actually qualifies. Both the House and the Senate agree on one key point. The deduction is only for people age 65 and older. But not everyone age 65 and older would receive the full amount. It depends on your income, specifically your modified adjusted gross income. The Senate plan has an earlier phase out. Single filers earning $75,000 or less can claim the full $6,000 bonus deduction. Married couples filing jointly get the full $6,000 per person, up to $12,000 total, if their modified adjusted gross income is $150,000 or less. Incomes above those thresholds triggers a gradual phase out, reducing the deduction as income rises. Now, the exact formula hasn't been finalized, but the premise is simple. The more you earn over $75,000 as a single filer or $150,000 as a married couple filing jointly, the less you'd be able to deduct. The House version starts the phase out at the same income ranges as the Senate version, but allows for partial deductions at much higher income levels. Single filers can qualify up to $175,000 as an annual income, and joint filers up to $250,000 as an annual income. So in other words, the House plan gives high-earning income retirees a longer runway before that deduction disappears. Again, this deduction offers the most value to the middle income earning retirees. For those who are single, say incomes ranging $30,000 all the way up to $100,000. For those married and filing jointly, maybe it would be the income ranging from $60,000 all the way up to $200,000. So if you're living on Social Security, a modest pension, and modest withdrawals, you'd likely qualify for the full deduction. But if your income is higher, maybe you have higher RMDs or ongoing income, that deduction may phase out entirely, especially under the Senate's plan with more strict rules. On the other end of the spectrum, seniors with very low incomes who already owe very little or no federal tax, this deduction really wouldn't help at all. That's why some advocates are suggesting refundable tax credits, which would be more successful at reaching even those seniors at lower income levels. But what about Trump's campaign promise? President Trump repeatedly pledged that seniors should not pay tax on Social Security. He even stated it in his 2025 State of the Union address. But in both versions, the Senate and the House version of One Big Beautiful Bill, many people were surprised to see that it didn't address taxes on Social Security at all. So why not? Well, it comes down to a special set of Senate rules. To pass this bill quickly, lawmakers are using something called budget reconciliation. It's a shortcut that allows them to pass tax and spending bills with just 51 votes as opposed to the traditional 60. But there's one big catch. They're not allowed to change anything about Social Security. That's because of a rule called the Byrd Rule, which blocks changes to Social Security, including how benefits are taxed, from being included in reconciliation bills. So even if lawmakers wanted to make Social Security tax-free, they couldn't legally do it through this process. Also, eliminating Social Security taxes completely would mean losing $1.2 to $1.6 trillion in federal revenue over the next 10 years. That's a huge hit, and one that would accelerate the rate at which Social Security trusts became insolvent. Experts warned that it would accelerate it by 1 to 2 years. So rather than exempting benefits, lawmakers opted for larger tax deductions, which offer immediate tax relief for seniors. They cost less to the government, and importantly, are budget rule compliant. So the bottom line for retirees is there's no full exemption for Social Security taxes. Instead, a senior bonus deduction offering modest, targeted savings. This route was chosen because it's politically easier, rule compliant, and less damaging to long-term federal budgets. And while the senior tax deduction is one of the most prominent features of the One Big Beautiful Bill that is making headlines, there are some changes to some major programs that seniors as well as lower income families rely on, and here's what you need to know. First off, Medicaid. Hospital funding is on the line. Within the House plan, right now, states can charge hospitals a special tax to help bring in more federal Medicaid money. The House plan freezes how much they can do that, which limits future flexibility. It also reduces the payments that can go to hospitals that are serving a large number of low-income patients. Overall, it slows down the growth of new funding, but it doesn't cut any existing funding. The Senate plan goes further by cutting how much states can charge hospitals, lowering it from 6% of revenue down to 3.5%. This would mean less federal money flowing to state Medicaid programs, especially in places that rely heavily on this setup. The Senate version also cuts funding to rural and safety net hospitals, which could ultimately lead to layoffs, fewer services, and even closures, especially for hospitals that may already be struggling. There are also proposed expanded work requirements to keep these benefits. Within the House plan, it would require able-bodied adults aged 19 to 64 without dependent to work or volunteer at least 80 hours per month to keep Medicaid. There are special exemptions allowed for those who are seniors, those with disabilities, those who are pregnant, those who are caregivers, and the others within this group. The Senate plan expands work requirements to include parents of teens aged 14 and older, significantly widening the scope. It also significantly narrows current exemptions, making it harder for many to qualify and putting many of those who currently have this benefit at risk of losing it. Let's also talk about the SNAP food program. The House plan adds stricter eligibility rules, including tougher assessment tests and copays for individuals slightly above the poverty line, which does ultimately suggest that millions who currently qualify for this benefit could lose it. Within the Senate plan, it expands work requirements further and reduces access for legal immigrants. The result is deeper benefit cuts, with many legal residents at risk of losing essential support. For many older adults, especially those in rural areas or running on tight budgets, this could easily mean less access to care and more financial pressure within their lives. So while the tax deduction is real, it's part of a much broader package, and not every senior will come out ahead. Now, the House has already passed its version of the bill, featuring the $4,000 bonus deduction for seniors in a razor-thin vote on May 22nd. The Senate Finance Committee has released their own version of this bill, which includes the $6,000 bonus deduction per senior, deeper Medicaid cuts, and different income phase-outs. It has not yet been sent to a full Senate vote and is anticipated to do so on or before July 4th. We know they're not going to be in session on July 4th. But key pieces are still being negotiated, including how big the senior deduction will be, where the income phase-out begins and ends, and whether the deduction will expire after 2028 or be made permanent. Currently, as it's written, these bonus senior deductions are set to expire after 2028. So what happens next? Here's where things can shift, and fast. The Senate may amend the House bill directly, or they can vote on their own version. If the Senate passes a different version than the House, the two chambers will form a conference committee, a small group of lawmakers from both sides, to create a compromise bill. That compromised version could include blended elements from both bills or new changes altogether, but then would have to go to both the House and the Senate for another vote. Only when both chambers pass the exact same final bill does it go to the president's desk to be signed into law. This bill could absolutely lead to real tax relief for millions of Americans, especially seniors with that bonus deduction. But keep in mind, there's still a lot tucked within this bill. And also keep an eye out, because the version we're seeing today does not mean that that's the version that gets signed into law. We're still waiting to see what gets finalized. What are your thoughts on the one big beautiful bill? Leave them in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Combined income from part-time. I don't want to say where it's coming from. If I say where it's coming from, we're inevitably gonna go down the hole of provisional income, and I don't want to do that. Or capital gains, long-term capital gains. I can't talk today. I just don't want to do it. It's too much for this video. We can do it in a different video if you want to. Leave it in a comment, but I'm not doing it in this example. So I'm not even going to say where the income's coming from. That's okay. Just sorry about my tangent, but I'm not discussing provisional income here. I'm not doing long-term capital gains. I'm not doing it. I'm not doing it. Standard deduction, that's it. Nothing else. Incomes rise. Income rises. I made incomes plural. Let's make rises plural. Income rises. That would be phrasing it better, don't you think?